Hey, active traders, welcome to Breakout Trading Success Secrets with Harry Boxer and myself, Ken Calhoun. It's great to see so many of you here. And Harry, it's always a pleasure to share the stage with you. Welcome to tonight's event.
Thank you, and thanks for having me, and it's always good to be with you.
All right, so traders, Harry's going to lead off with the first half hour, and then I'll pick up the second half hour. As always, all information's for educational use only. We're not making advice about what to buy, sell, or hold, etc., etc. Let me introduce Harry Boxer. Harry is a world-class expert, one of the very top guys in the whole industry, and he has my 100% recommendation. He's an outstanding stock picker and the best breakout chart guy I know out there. So he's a columnist on TheStreet.com and Forbes. He's been on CNBC. He speaks at the Money Show events. He wrote a book called Profitable Day in Swing Trading, which at the Money Show sold out in record time, like 15 minutes. All the copies were gone. So Harry Boxer is a great guy to work with, and I look forward to seeing him tonight. Let me go ahead and turn the presenter controls over to you, Harry, and take it away.
Title of my book, Profitable Day in Swing Trading, is a book I wrote. Basically, I felt that I had some technical experience over 50 years, and I converted that into day trading experience about 15 years ago. And I found that charts pretty much repeat in all time frames, from daily charts down through 15-minute, 1-minute charts, etc. And during the course of this day trading session, now my site is also for swing traders because we've had some phenomenal swing traders this year. But for the most part today, I'm going to talk about day trading using 1-minute charts and breakout moves. Now, if you can see from the title, using price volume surges and pattern recognition to catch big moves in the stock market. Well, that's what I do on a daily basis as well as for my swing trades. If you basically, I'm a big believer that you need to prepare properly. One of the best things about being in my room is I spend about 45 minutes going through all the pre-market trading, all the stocks that are gapping on news, and all the related news and why they're gapping. I also look at the charts. I analyze the price patterns for support, resistance, and maybe set targets, and put out what I call a focus list of anywhere between 8 and 15 stocks in the morning that we're going to center our focuses on for potential trading. And of course, as the market opens, other stocks gap and run that we weren't aware of. So I'll always subtract and add. But what we're going to do is we want to analyze patterns from the previous day because there may be some setups, and they're also put on my watch list. My morning routine is set up, as I said, with spending about 45, 50 minutes going over all that information, creating the focus list, issuing the focus list, and then about 20 minutes before the 9 o'clock hour back east, I will get online with my people on a live webinar, and I'll go over all these charts, show them the patterns as they're developing, not only on the daily charts, but the pre-market patterns and the 1-minute charts, and showing you how the patterns are forming, what kind of volumes trading in those stocks to get us set up for what may be buy alerts as soon as the market opens. So, and what we're looking for? Well, what we're looking for is pennants, coils, flags, something basically a stock is gapping, pulling back, consolidating. I can show you lots of examples, and I will today, but I wanted to spend a minute telling you what I'm looking for. In addition, I'm looking for 5-wave intraday moves, stocks that are able to pop and pull back and then have a 3rd wave and then a 4th wave pullback and then finally a 5th wave. Some examples of stocks that we've been trading over the course of the last several years, and I can do this alphabetically, of course, if you like, but here's some really cool examples. These are actual stocks that we traded. And here's one of the reasons I traded this stock. I want to point this out to you. In the morning, pre-market, there was a gap pre-market. This is not a pre-market chart, but it shows you what it looked like at the opening, where it gapped up and ran up and pulled back from the wedge. The volume got very quiet near the apex. This is what I look for. I look for opening consolidations where it gets very quiet, very narrow, the volume is very low, and suddenly it surges and the volume picks up. In this case, we bought it right there at about 25, 60, 65 area when it came across that high. And within 4 hours, it was trading about 28.60. It was up 3 points, or about 15%. A nice 4-hour trade. But you can also see that during the course of that trade, the stock popped again and coiled, popped again and had a bigger coil, never violating support. That's your support. Ran up again, flagged. Now this flag made a slightly lower low, but it did not violate the parallel trend line. And then towards the end of the day, reached up just under 29. And that's a perfect example of the perfect day trade. Why do I consider this a perfect day trade? Well, because it never violated support. It went up in a rising 45-degree angle type pattern, and it kept consolidating bullishly on low volume, bullishly on low volume. Did it again, and then finally, at the end of the day, in the last hour, whenever you choose, you can take it off the table. But what I normally do, because I remember distinctly this one, I set a target at 27, so it hit it right about there, in that zone. Several people got out. Some people sold half. I set a secondary target at 28 and a quarter. It hit it there. And so we had a nice couple scalps and trades during the course of the session on this one. And this is not a cherry picking, because there's dozens and dozens and dozens of these happening literally every day. Another example would be AMCC. We started the day with a little gap. See the volume right at the opening. Ran up and pulled back, and then formed a coil. At the apex of this coil, it got very quiet. You see right there. Very, very, very narrow volume. Broke out at a rising type consolidation and accelerated. Flag, popped, flag, popped. But you'll notice one thing. This line, the trend line, never broken all day. And again, the 45-degree angle. One of the best things about this, as I tell all my traders, it's a low stress-free type trade. Why is it stress-free? Because it never gives you a reason to sell it. Now, one of the things I keep hearing every day from my newest subscribers is, I sold it too soon. How do I stay in a stock? Well, how do you stay in a stock? First of all, how do you get into a stock? In my opinion, you buy a tranche here. You buy another piece there. And believe it or not, you can buy a third piece there. And then sell the whole thing there or there or there. It depends where. Or if you're stopped out, obviously you would have sold it. But in a case where you're in it, you can sell it, buy it in waves, in tranches, and sell it in tranches. This way, you're guaranteed taking profits. You never have to worry about, I sold it too soon, because you always have a piece of it left. There's some skin in the game, so to speak. Another example, Anika Therapeutics popped, ran up and had a perfect wedge, and then broke out and pulled back, and then broke out again and kept stair-stepping his way up, literally going from where we bought it at 25 and a quarter to 27 and 3/4. It's a nice 2.5 point trade in 4 hours. Again, the parallel channel didn't violate till right there, and it actually never violated its lateral support. So you always have a choice. Do I sell a piece there and keep the rest? Well, if you did, you'd be in it till the end of the day. You don't know whether this is going to consolidate and go higher or not. Some more examples. Hang on one second. ATRM. This is a beauty because it popped right out of the get-go and exploded. Now, how many people would have bought this stock? Well, literally, this is a 2-minute chart. So in about 8 minutes or 10 minutes, the stock formed a little wedge. The volume got very quiet. See it down here? I might call this the low volume ebb. Before every major move, you'll see a low volume ebb almost invariably. So basically a huge gap and a huge run. This basically went from $5 to 8 and change in minutes, and then pulled back. So who the hell would buy the stock here, right? Well, your stop was under here, about 710, under 7. When it broke out, and this thing ran from 7.5 to 9.5 in another 10 minutes. Then it took several hours to coil. But that bull coil set it up for a late move. It took it from 8.5 to 12.5. Yeah, I know it sounds crazy, but yes, this stock did go from 5 to 12 and a quarter, 150% in one day. And those are the kind of trades we dream of and look for every day. And they're there. They really are. Let's take a look at Avon. And this is a huge gap up and a strong run in the first 3 minutes. Then the falling wedge. Notice the volume get very quiet on the pullback. And it popped out. This is where we bought it. It ran up and wedged. It ran up and pulled back and held that channel. Didn't violate that channel until there, but it also didn't violate support. The previous high and the pullback lows held right there. Notice that? And then towards mid-afternoon, it ran again to 21 and change. We got in at 19 and a quarter, so it was about a 2 point trade in it right there without violating price support. Yes, it violated the trend line, the early angle of ascent. Sometimes I'll violate the angle, but not price support. That's a good case right there. CLDX, that's a beauty. When you see a stock pop with big volume early on and then form a nice little wedge, the volume gets very quiet near the apex, pops out, forms a little flag, explodes and forms another flag. But notice the bottom of that flag is near the apex of this wedge, not far from price support. It did not violate this low in here. Popped again, ran again, and then channeled up. Only here, about 315, did this stock actually break its accelerated trend line. But in this case, this stock went from 19 and a quarter to 21 and a half for a $2.20 trade, or about 15%. Not too bad. Again, a rising channel. That's what you want to see on a stock like that. Perfect day trade is when you're in a stock and it starts to channel up and rise. So I'll go on with some more examples in a moment, but what you want to do early on is analyze the early trend development. So I come on after 10 minutes after the market opens, and I do my first update, and I call that the early pattern development session, where we look and monitor the early price action, early volume action. We've already created a focus list. We may add to it or subtract from it, but the key is to develop a disciplined, organized, and focused approach. One of the problems on my site is there's hundreds of people throwing symbols at me. And I keep telling them, I don't need any more ideas. Folks, I just gave you 12 to 15, 18 ideas. How many more do you need to make money? Everyone wants to be the idea person. They want to give me the idea that makes money for everybody. It's not necessary. Believe me, it isn't. So there's something really unique called Volume Buzz from Warden Brothers. What is it? And this is the only place you can find it on Telechart, TC2000. At any given point in the trading day, the indicator looks back over the previous 100 days and normalizes the volume at that point, that moment, or that minute of the day. It makes a comparison of today's volume with that average volume. It compares the volume of the stock at, let's say, for example, 9:45, right at 15 minutes after the opening, the last 100 days. When you see a stock that's up 2,000, 3,000, 5,000% above normal early on, it indicates money flow and perhaps sponsorship, and showing that there's a lot of interest in that stock early on. So let's move on and show you some more examples of what I look for in addition to what we just showed you. Here's a beauty, solar stock, China Sun Energy. It popped sharply. Now it opened lower, but then it popped sharply and formed a wedge. That's what got my interest. When it broke out and got some, it started to move, particularly when it went across the high here. We bought it around 470. Now it ran up to about 520 real quickly, and then went into a 4-hour sideways consolidation. I know traders eat this, but quite frankly, if this is building up a nice little mini base in the form of a bull coil and then breaks out, look at the volume pick up as it breaks out. This went from 492 to 695, 2 points here in an hour. So if you were patient, you did very, very well with this stock, taking it from 4.5 to almost 7 within about 4 hours. And again, in a rising channel. Only here did it actually break. And of course, some more examples. One of my old favorites, a stock I made a lot of money on, literally tons of money, in Dendrion. Now, this is one, because I had stock in the 4 range, and the stock ran to 55 on positive drug news. But you can see that this wasn't the day. It popped, coiled, and broke out. When it broke out during the volume increase, we bought it around that 6.5 range. Watched it pop and coil, and then pop and have a rising coil, and just keep going, stepping its way up. Notice this trend line wasn't broken until there. This literally went from 6.5 to 7.25. Not the biggest move, but I'll take it. About 12%. At the end of the day, you see a little bit of a collapse. But there's so many of these every day. It's unbelievable. In my site, people just are amazed when they come in and see the kind of work we do and the kind of stocks we pick, and the results we get too. Here's a really amazing move. This is a Chinese semiconductor stock called DACO Energy. This one ran up and formed a little pennant. See that little flag or pennant right here? Look how quiet it got, almost didn't trade right there at the apex. And when it popped and a volume came in, we bought it, I recall, about 22. And within 30 minutes, it was 27. 5 points. If you think that's good, it then pulled back to support, ran up and pulled back and coiled, broke out and ran all the way up to, believe it or not, 35. 35 from where we entered at 22. 13 points in 4 hours. Those are the things that dreams are made of when we're trading, right? But you notice it never broke support here, 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 or even here, which tested that support. So, but we had targets and got out a bit early. I got out, quite frankly, I told my people that at 27 and 30 were my targets, and we got up to 35. Some people held on to it because it didn't violate support, but it was a killer trade. And a couple more to show you, and then I'm going to show you some stuff from yesterday, believe it or not. Here's an interesting stock, Ellie Mae. Popped in a wedge and then broke out. It was so explosive, we bought it as soon as it popped here at 25 and a half. And literally, in 20 minutes, it went to 27 3/4. I told everybody it was too far, too fast, expect a pullback consolidation. Well, it did pull back and coil, and then eventually made a higher high, but it really didn't do a lot more the rest of the day. Nevertheless, it never violated its stopping point. Never. Interesting stock, Phonar. Big gap, explosive gap, and then it pulled back and got very quiet and popped out. We bought it around 1364. And it never violated support, and by the end of the day, it spiked to 18, and some of us got out right there. Nice trade. But you can see this is what we look for. When you're day trading a gap, you want to see a pullback that doesn't pull back too far, that holds the first pullback low. And notice the retest here was a little higher than the breakout in the run-up. That's the ideal trade you want to see. Now, Ken, I'm not sure if you want to spend any time at the end of this session taking questions from people, or you want to wait till the whole thing's over between you and I. But in any case, I'll just go on and you can tell me what you think at any point.
Yeah, probably got so many people here tonight. Let's not do questions, just in the interest of time, because your content's rockstar. I'm sitting on the edge of my chair listening. So let's just focus on content. We'll have to defer doing any questions. So.
Yeah, no problem. Now, First Solar is a personal favorite of mine. I've traded it so many times I can't even remember. It popped, it formed a little wedge and broke out. This is where we bought it at around 30 and a half. Within seconds, it was 31 and a quarter, and then it pulled back down, held that level, popped, held it again, formed the wedge, exploded, formed another wedge, exploded, retested the prior high. And you can see how it skips there, stepping up. And really, until here, it didn't break its channel. Basically going from where we bought it at 30.65 to about 32 and a half, or 32 and a quarter, whatever that was. That was a nice day trade. See, and by the way, I have a personal philosophy. There's a reason why traders, why stocks peter out around noontime, a lot of times, like in this case. And that's because if you're a professional trader in a stock like First Solar, and you are trading the house money for a brokerage firm or an institution, you get paid a percentage of your profits. So if you have a move that moves in 1, 2, 3, 4, 5 waves, with this being a fifth of a fifth, by noon or thereabout, or by 11:30, 12 o'clock, usually it's a good sell because a lot of the traders go to lunch, they take their profits and they go. And that's really not a theory. I've talked to dozens and dozens of traders, and they all do it. So I have a 5-wave theory. It's basic Elliott wave, 1, 2, 3, 4, and then 1, 2, 3, 4, 5. So basically 5 waves. The fifth of the fifth, just before lunch hour or at lunch hour, is usually a good place to sell. That's my personal theory. A few more ideas, and then I'm going to show you some stuff from yesterday, just to prove that this isn't cherry-picked over the years. Because it isn't. FXEN. Popped and coiled, broke out but didn't get to the high, and we didn't buy it till here, about 4:10. Within 2 hours, it ripped to 620. But notice how it never violated this line, actually accelerated, and when it pulled back here, it formed a wedge, and then exploded out of that. Fantastic trade. And one more, and then I'm going to go to some of the stuff from today, yesterday. Okay. The next stock I want to show you is GIMO. Now, this is one of my personal current favorites. I've traded it a lot, but this is from 3-4 years ago. It popped and coiled and broke out. This is where I bought it. A little frustrated when it popped, pulled right back, but it never violated. We held it. From there, 28 to 31 nearly. 3 points in 3-4 hours. Very nice trade. And that's typical of what we want to see. Now, sometimes, you don't always get the exact pattern, but as long as it's up and coiling or flagging and not breaking support, you have a chance of it extending like this did. And another example is Kong. Popped, formed the wedge, broke out. We bought it right there. It then ran up and came back, but it held that support line. It ran up and flagged, ran up and wedged all day. Never broke that line. Here's a stock that went from 12.40 to almost 15. Nice trade intraday and a beautiful rising channel. But the trigger was the pop and the consolidation and the breakout of that consolidation right there. That's what we look for. Now, let me show you some stuff that occurred just yesterday. These are stocks I took off in preparation for this. WRLD, where are you? All right, I'm not seeing it. I'll tell you what I'm going to do then. Let's switch to my charts. And go to a 2-minute and show you that yesterday it popped. Notice the little wedge in here. Early action. And broke out. We bought it at around 75. It ran up and coiled and then it exploded. By the end of the day, it traded up to 86. This is an 11-point run. Our traders love this trade. This was a beauty. All day, never broke support. And you can see the way it looked before. And by the way, the day before it gapped and coiled. The next day it gapped up and ran. Here's a stock that went from basically 55 to 90 in 2 days. It happens. Here's a stock we traded twice in the last 2 days, Teladoc. First of all, it exploded and pulled back. Yes, we bought it here when it broke out at about 27.5. And by the end of the day, it traded up to 28.5, coiled, popped, and today was trading at 31. Some of us put a swing on this one. Notice this angle of ascent. A 2-day rising channel, never violated. As a matter of fact, it's almost a perfect parallel channel. And tomorrow we may very well see 32. But again, if you're in a stock, there's no reason to sell it except at your targets. This was a target. Now, people are always saying, well, what are those lines? Those lines are from prior highs or prior lows. They're resistance to support levels that I always draw on my charts, so I don't have to look for them when I'm trading. They're there. So when I went in here at a target of 27.5, I had a target of 29.5, and we got 2 points within about 3 hours, and then it kept going. So this is just yesterday, and this is today. This is a 2-minute chart. There's a 1 minute for today. Even today, it popped, coiled, and broke out. I could have bought it right there. 29.5 to 31, not too bad a trade. Wayfair, how about this one? Yesterday. Popped and pulled back, formed the wedge. When it broke out of the wedge, we bought it at 59.5. And within a couple hours, it was 63.92, or about 4 points. You notice that it did pull back at the end of the day and after hours, and today was up again. ENDP. Notice again how it popped sharply. It was in a sharply rising angle. We bought it right there at 12.05. Traded up to 12.85, 80 cents right there. Pulled back and held support. Eventually got up to 13. That was my target, 13. After coiling for a couple more hours, it broke out. That was this morning. But notice that that line held for 2 days now. PTLA is another great example of a stock that popped, wedged. Hard to see. This is a 1 minute chart but it goes for 2 days. When it broke out there, it was so strong, we went in and bought the stock for a quick run. It went from 39 to 40 and a half in minutes, pulled back from the falling wedge, and then a larger wedge broke out, had a falling wedge, but notice the rising angle didn't break it until here. But eventually, from where we entered here at 38 and 3/4 roughly, it went up to 42 very quickly. That's the kind of stuff we want to do every day if we can. That's look, it's my job to find these stocks for you every day. AMRI. Yeah, this is interesting because it opened up and then dropped hard. But when it broke out, it formed that wedge, and then started to break out, we went in, it popped, it flagged, and then look at that run. Basically going from 16 to 1865 in about 3 hours. Great, a really nice day trade there. How about NVIDIA? Did you see that sucker today? Well, most people wouldn't have bought a stock that gapped from 103 to about 113, right? That was pre-market. By the time it opened around here. It took a dip and then broke out and wedge. I didn't buy the stock until after it broke out of the wedge. And then it didn't do much for a couple hours. It formed a coil. But eventually, from 116, it got up to 122 almost, 121.80 and change. A new all-time high, by the way. Look at the daily chart. This is a key breakout today. Massive volume of 53 million shares on a breakout. I want to point out on NVIDIA, just to interject, the last 4 times it did this. Here, it led to that run. Here, it led to that run. And here, it led to that run. Is this going to lead to a big run? I think so. I think now that it's broke, if this gaps up tomorrow, this is going to, my near-term target is 135, but I think this could be 150, 60 in the next few weeks, provided we don't get a market crash. Nevertheless, a large, what looked like a head and shoulders has turned into a wedge. The one thing I want to point out to you, or a coil, the one thing I want to point out to everybody, everyone anticipates or looks for head and shoulders. They're not a head and shoulder until they break the neckline. This never broke the neckline. I told all my people, it's got to take out 95. Look at the low, 95.49. 95.17. It never took out 95. And here it is, 121. It probably had it higher. A few more. One of my favorite junior bios is Kala Therapeutics. When it broke out there, right in there, I gave my people a swing trade of 6.5. My targets were 10 and 14, I think it was. Look what we reached. 1490. Then it pulled back for 2 months and formed a big coil or wedge pattern. Today it popped out. That's a big sign that this stock wants to go higher. And it took out a double top. My targets now are 17, 19, and perhaps in the low 20s. Great looking junior biotech. But the day trade we did as well. When it popped and formed this little wedge in here and broke out, I put a day trade out today at 11.75. My people got out at 13.25, 13.40 by the end of the day. Very nice day trade. And notice when it popped here and formed this pattern, it never violated support right there. It broke out. Some of us waited and bought some more here at 12.55. Very nice day trade. And it's also a swing. Now that's the thing about swing trades. I get a lot of my swings from my day trades because they're usually emerging from a key area that could, and particularly if there's a big short position, could fuel the fire from much higher levels. Just a few more, and then we'll call it good for today. Here's one from ARRY. Yesterday morning, it popped, pulled back on a wedge, and broke out. When the volume got real heavy, we went in about 770. And within an hour, it was 9.25. Not quite, 909, sorry. So it went from $1.30.35 right there. I told all my people, because it was my target, and there was resistance there, take your profits at that level and wait. Well, we never got another opportunity to go in. And lastly is SGRY, Surgery Partners. Look at this pop from the get-go, and look at that beautiful coil, or wedge, whatever you want to call it. Look at the volume at the apex is barely trading at all. See that empty space there? It's right at the apex. Look, it hardly was trading. And when it finally popped, we bought it at around 19. And within 3 hours, it was nearly 22. That's today. Today. So those are the kind of things we look for in our site. And I welcome, you can get in my site now for 2 weeks for free. No credit card required. I invite everybody to come in spend some time in the trading room. I think you'd be blown away. And what do you got to lose? Absolutely nothing. It doesn't cost you a nickel. You don't even have to give us a credit card. But if you like what you see, you're welcome to come join the community. It's a group of several hundred people, and they are not only nice people, smart people, good traders, but mentors. If you're a newbie and you want to join, or you've got light experience and you want to learn some more, I would say that I was told 2 to 3 months in my side is equivalent to 2 or 3 years in the classroom. And that's today's presentation. Ken, over to you.
Hey, thanks, Harry. Great job. Outstanding. Hey, let me ask you a quick question. I was carefully thinking, get a lot out of the one smart question I ask you. You and I both specialize in breakouts, and I don't know if you're like me. I've traded the same patterns I traded back in the late 90s. They still work perfectly today, all these years later. My question for you is, and this is especially for traders who are newer to day trading and swing trading for that matter, is traders often are afraid that they're going to be buying the high, and so they're afraid to buy a new high. I specialize in buying high, selling higher, and I know you do that. Well, you do variant to that too with breakout trades. But any words of wisdom for the world's traders into how to coach them into not being afraid to buy new highs on breakouts? Because that's where the money's at. That's showing strength, but it's a hard sell because people think they're going to be the sucker paying more than everyone else paid earlier, so they stand aside and then it runs up without them. So any idea on how they can get over that?
Well, there's a couple ways. First of all, remember what Jesse Livermore said. He's one of the most famous traders in history. Buy high and sell higher. He loves stocks that are making new highs because there's no overhead resistance. People are trying to get out even. Okay? Yeah. Okay, that's number one. Number two, we don't buy necessarily the highs. We look for the pop and the pullback, and we then wait for the consolidation to break out. And that's when you have your optimal period. But you don't even have to buy it all. If you buy a little here and it's running and you like it, buy some more. And it runs some more, buy some more. If you want to, like I said, the one thing people don't do is they don't scale in and they don't scale out. It's like hit the sell button, you sell everything. I never do that. And I'm a position player. When I see a stock that I'm swinging in a position, I'm usually in at 3 or 4 different tranches, and I'm usually out the same way.
That's smart.
Especially when I accumulate a position, it's between 20 and 50,000 shares, depending on the price. So I'm not going to bomb the market with a sell for 50,000 shares at any time. I usually look for bids and hit the bids. That's the way I trade. But at the same point, the number one thing you can't do, and I tell all my people this every day, you cannot trade from fear. If you're afraid of losing money, you will. It's like you get what you fear the most. Absolutely get what you fear the most. And if you can't trade, you can't, like, Joe Granville was the best. He once said, and I'm sure a lot of people, the old timers like me, because I just turned 70 this year. I'm sure a lot of old timers know who Joe Granville was. He was at one time one of the most influential people on Wall Street. He had a subscriber service that had 2/3 subscribers, believe it or not. And when he made a comment, it moved markets. He used to always say, the market climbs a wall of worry. And boy, are we doing that now or what? Okay? But more importantly, he said, is you would be better off not knowing the name of the company because you get emotionally involved. If you just saw a chart and you traded the chart based on the parameters that, and without a name of a company, if it had a number on it, and you put your broker an order into buy stock 123, instead of buy, GoPro. Everyone got excited about GoPro, and I told my people at 38 to buy it, and I also told them to stop at 90, which they did. The stock went down at 9. Because everyone's excited about the product. You cannot fall in love with a company. There's a good time to buy a bad stock, and it's a bad time to buy a good stock. There's a lot of bad stocks gapping and running every day. I tell my people, scalp them and get out. Okay, there's so many stocks that we trade every day that are lower price stocks that will run 30, 40, 50, 100% in a couple hours, and you better not be there when the music stops. You know what I mean?
Yeah,
but you can't trade from fear. If you trade from fear, the one thing you've got to get over is the fear of losing money. You just can't do that because you will lose money if you fear about it. If you're dating a woman and you fear that if I don't do this, I'm going to lose her, you will lose her. It's the same thing with stock. You can't fear a stock. It is nothing but a piece of paper, and it's a tool to make money. So trade the patterns and forget about what the company does. Particularly if you're day trading, you should have no care about what the company does.
Right, good point. And I like what you said about, I always say, feed the winners, starve the losers. And that's one thing that I have a heck of a time, whenever I speak publicly, I always ask, how many of you guys add to your winning trades? And I get 1 out of 10 hands show up. And that's complete wrong. You should always scale in at least once or twice on a day trade, more often than on swing trades, and scale
Yeah.
out. So it's not an all or nothing, pull the handle on a slot machine and hope for the best like the newbies do. So
And just a quick story. The biggest money I ever made in my life was a stock I bought in 1999 for 17 because of an institutional client who liked it, and I loved the chart. And it went to 27, and I doubled my position on margin. And it went to 47, and I doubled that position on margin. I never put up another nickel because the stock was going up so much. My margin buying power kept increasing. And finally, when it went to 80, I bought my last tranche. I had 5,000 shares of the stock at an average of about 37. And this is a great story, Ken. This is absolutely true. And I looked at the chart, and my institutional client who gave it to me said, "What's the chart tell you? What's it look like?" I said, "The top of the channel long-term or intermediate term says in the next few weeks to months, it could be 120. So I put my order in a sell, 120, Ken. I kid you not. And you know what happened?
what's that?
I'm on the beach in Hawaii at 3:30 in the morning in the dark with my cell phone talking to my broker back in 99. And I said, "Where did it open?" He said, "It closed at 103. It just opened at 108, and it's trading at 111. I said, "Where's my order?" He said, "At 120. I said, "Raise it to 125. So give me the break. I had the stock in 37, and I could have got out of all my stock at 120 and have been a superhero. So what happened? It hit 120 to the penny, closed at 104 that day, and I got stopped out the next day at 93 as the stock collapsed.
Oh, good exit though. You made your money, so well done.
I know I made money, but I gave away 27 points on 5,000 shares. You figure the math.
Yeah. But hey, you were in early and you let it go and you built the trade over time. So that's a smart way to trade. So hey, thanks so much, Harry Boxer. You're great, man.
That was my point. I averaged up, and it didn't cost me a nickel because I was on margin. Very reckless of me, but you know what? At least I kept raising.
That's what a professional trader like you does, and that's what I hope all the traders out there are taking notes and paying attention, because that's the way you make it. So thanks, Harry. It's always an honor working with you, man. You're one of the best in the world. So it's always great working with you on these things.
My pleasure. Again, just folks, come join me for a couple weeks for free. I think you'll love what you see. Just go to www.thetechtrader.com and again, sign up for free, and you'll be able to witness what we do every day. Here's Ken.
All right, thanks, Harry. Yeah, I appreciate it. It's a pleasure, man. You're one of the best in the world, so it's always great to share the stage with you. You really help traders, so you're one of the rare people who actually help people. So thanks so much.
Awesome. Take care, everybody.
All right. Well, I always learn a lot. Learn from Harry Boxer. He's one of the best. Let's start off with a couple of quick day trading charts. I'm Ken Calhoun. I'm Trade Mastery Day Trading University. Harry mentioned ARRY. We got in late. We got in at 8:50, and we sold 9:10. So I got out near the point where Harry did too. But this was one of our live room calls today. I tend to be conservative. I wait for new breakouts. But that was our trade today in AARY. Another one I got our traders in today was COTY. And we got in 19.5, sold to 20.2. So we didn't get the exact top or the bottom. But this is another pattern that I want you guys to memorize. Gap continuations above a bullish cup, right? So this thing gapped up at a nice large candle here on high volume. Took out new highs. I got our guys at 1950. I had us go in. We added at 1920, and I said use a break-even stop there. So the second entry, scratch trade, the first one worked out for 70-cent win. Anyway, gap continuations, the best charts in the world, and those are the type you want to focus on. Now, another quick thing to look at from a day trading standpoint, I'm mostly going to cover swing trades for you guys today because Harry did such a great job on intraday. I'm going to cover some swing trading charts. But one of the things you want to do as a professional trader is always do what I call use tape reading. And that's what I'm looking for. And again, this is a different chart. Need to have these things linked up. This is my swing trading presentation slide. One of the things you guys want to look for in your intraday trades is a increase in share size and speed and transaction flow. So whenever I'm reading the tape, and I know Harry mentioned Jesse Livermore and his Reminiscences of a Stock Operator is a great book. Look at the pattern of the tape. What you're looking for is how fast it can chew through each 10 cents of price action. So how fast are we able to climb through each dime of price during the open, during the first half hour, 45 minutes? And what you're looking for is an imbalance in sizes, larger numbers on the bid than the ask. You want to see block trades going off, 500, 1,000 shares or bigger. And the main thing from a tape reading standpoint is price. That's the ace of the deck. and volume, your size is the king of the deck. Well, anyway, I'm looking for how fast price action is able to chew through each 10 cents worth of price action, and then I'll start building trades or adding to a trade to scale in once it continues up. So make sure you've got a nice large clean tape like this. The older I get, the harder it is for me to see. So I like nice big 18-point or 16-point font. I intentionally decolor my time and sales window so it's black and white. I wrote one of the first articles called The Tale of the Tape for the now defunct Active Trader magazine, back when Bob was running that over a decade ago. And my first appearance for Money Show, back then it was Online Traders Expo, my buddy Tim Berkwin and his colleague, back in the year 2000. That was my first public appearance on professional trading, and I spoke about tape reading way the heck back then. We had a packed crowd. It was 180 people in standing room only, and I was talking about how to read the tape with the live tape in the markets. And as you learn the nuances of how to deploy against the charts, look for the patterns that Harry teaches you, look for the patterns I teach you, and look for incremental, breakouts above each 10-cent price window as the key support or resistance. Gap continuations, I won't say they're money in the bank, but if my life depended on it, and my financial life does, that's what I focus on, as does any good trader. It's, ask any good pro trader. Well, I'll tell you gaps are our favorites, right? Because gap runners are the way to trade the market. Now, today I want to start off by looking at a couple of great swing trading charts. And we're going to look at both the 15-day as well as the 90-day, but mainly the 15-day charts. And as you can see, I know, Harry also likes 45-degree angle breakouts, as do I, and I like nice tight channels like this. This is Taiwan Semiconductor, TSM. The semis have been on fire. I like stocks between 15 and 50 a share, usually 20 to 70 a share. You may have seen my articles in stocks and commodities. But these are the type of charts you want to focus in on. For those of you who are new to working with me, just a quick intro. You may see me, I'm a regular columnist in technical analysis of stocks and commodities with my Trading on Momentum column. I've been all over CBS Market Watch, Money Show, TheStreet.com. I used to run Day Trading University. I since migrated the site under my Trade Mastery umbrella, but I've been teaching traders since the early days. And, I speak at the Money Show expos and all that too. So I've been around for a while. And this is the younger Ken, back like 10, 12 years ago when I did a video interview on tape reading, position sizing like Harry talked about. And also one thing for swing trading, kind of a tip number one to write down is it's better to trade wide than to trade deep. So by that, I might be in 15 different positions, but just 50 or 100 shares each. I'm not going to be trading 1,000 or 2,000 shares in one or two stocks with the magic chart pattern, because that's a losing game. It's a numbers game. It's all about the math. The chart patterns help scan, but ultimately your success as a trader is throwing a lot of darts at the market with the chart patterns, but trading a lighter share size across the bunch. And the half of the ones that stop out or go sideways, you take smaller, close to break-even stops. The ones that do start to run, you position size and scale into them. So today I've got just around 15 minutes left, so let's take a look at some of the best patterns, minor gap continuations, multi-day high breakouts, and more in our charts. That's it for PowerPoint. So let's take a look at live charts. What I want you to get out of the remaining 15 minutes today is the types of charts that I like to trade. And you will see that they're defined by consistent uptrend continuations. Applied Materials is good. Activision is good. One of my favorite patterns that you may well want to learn is what I call an acceleration ramp. And that's basically where you've got a steady uptrend that then gets new buyers, that takes out a new eye, kind of like a hockey stick, right? Preferably with a gap like today in Activision, right? These type of charts are so excited with such high volume, and they've got steady uptrends, right? The tail, kind of like a poker tail, was the first gap back here. And if that wasn't enough, you got another little gap there, and another gap, and another gap, and another gap. This one faded, held support, and took off to new highs, and another gap today. Give preference, writer downer number 2, give preference to stocks with multiple embedded gaps over a 15-day time window. I've got an article on stocks and commodities on trading multiple gap swing trades, and that's a very important kind of a poker tell that the institutional guys are so excited they're tripping over themselves to own shares. They'll even pay more than it was worth a few short hours ago, and the gap tells you the new buyers are on the horizon because they've got a big client order that they've got to work, and it materializes over time. So as active traders, we look to capitalize on that. You know, the punchline is gaps are easy to find, but the problem is you guys are often trading gaps that are too big or too small. I prefer smaller gaps, but the trick is you got to trade gaps that are above the previous day's high and typically less than 10% of the price. Now this one's more than 10%, so it pulled back a little, but ultimately it did regain new high breakout pressure, going all the way from 28 to 36. So we got an 8-stick run, an 8-point run in EXAS. Right, that's a good chart. It's resting right now. It's going sideways, so I don't really care about it until it breaks over, 36.50 for a swing would be my next entry. Here's another one, EZU, a gap continuation, gap runner. Here's another one. I'm just going to click through these quickly because I got more to cover, but these are the type of charts that a good professional trader makes their bread and butter because they have such dominant strength that it would be hard to get stopped out on if you were to trade it pretty much anywhere along the way. From a risk management standpoint, anytime you're in a swing trade, anytime I'm in a swing trade, I'm going to use a loss of 2 days support as the maximum stop loss. So in this chart, that's going to be what, 41.70. So if I built a trade over here, we're currently at 42.8. That's only a 1-point trailing stop, right? Or let's say Activision. Where would you guys get out maximum in Activision? 2-point stop would be right near 54, just under 54. So it'd be around a 2-point trailing stop, which is fine for a $50 instrument. EXAS, a loss of 2 days support would be right under 33.50, right? A bad way to trade is to use large stops and hope. A good professional way to trade is like squeeze the juice out of an orange or grapefruit, and it's a squeeze play. It breaks out to new highs at the first sign of trouble, not the second or the third time. You guys know who you are. If you have to conceal your trading losses from your spouse or family or friends and you don't tell people just how much money you've lost in the dang markets, stop the madness. There's got to be a better way. Your goal as a trader is simple. Make money. No excuses, no BS, right? You got to roll up your sleeves and get the right kind of charts out there. But the trick is tight stops and strong charts. If I were to be known for kind of like the way to lose weight and get in shape is found in 4 words. Eat less, move more. Okay, kind of that's it. You don't need any diet books. Eat less, move more. Kind of that's real simple, easier said than done. The success for active stock traders or the day or swing trade, I don't care what you trade, is tight stops, strong charts, right? Like the kind of charts Harry focuses on, the kind of charts I focus on. You'll find the world's best traders have 2 things in common. Number 1 is always going to be really tight risk management and decisive action based on that. The number 2 is the right charts that actually have good trade potential. So a loss of 2 days support, and by 2 days I always get this question, I mean today and yesterday, so whatever that is. So tomorrow morning it would be the aggregate of that day and whatever the current day's previous support is. So previous 2 days support, a loss there would be your trailing stop. I will build the trade every 2 points. So for all you math whizzes out there, said tongue-in-cheek, if I buy 100 shares at 36.50 or I buy 300 shares at 36.50 and I position size or scale in, where would be my next entry? Cue the theme song from Jeopardy. Alex, tell them what they've won. What would be the next entry, folks? If 36.50 is your first trade, where do you build the trade? Where the heck do you add to a winning trade? How do you feed your winners? How do you scale in? There is an answer. You always have to be thinking about it. As a professional trader, I've traded millions of dollars worth of stocks the last 17 years, and one of the things, as much as 4 million in a single freaking year. I'm a trader. I know how to trade, but I'll tell you guys, every trade that I make, I look at it like planting a seed in a garden. Not that I would ever garden in a million years, but if I had patience, which I don't, I would garden. Anyway, it's like planting seeds. Every trade that you put on should be put on with the thinking in the back of your mind, how am I going to add to this trade? That's vitally important. My trading took a huge turn for the better once I finally figured out position sizing. It's all about making the scaled in bigger winners pay for all your stop losses. And the only way to get big scaled in winners, like the great example Harry covered too, from building a trade from lows where it over doubled, is to add to your winning trades. Now I do that with buy stop limit orders. So I might put a buy stop limit 36.50, limit 37 for my first order. My second order flow is going to be a buy stop 38.50, limit 39. So I'll give it maybe 50 cents. I don't want to buy it if it gaps up 3 or 4 points. That's why I use buy stop limit orders. But you should always be scaling into your winning trades every single time. You're not going to make it. I am completely confident. I've worked with tens of thousands of thousands in person, and tens of thousands have read my articles and seen my videos and all that. I am completely 100% confident in saying you will fail as a trader if you do not use position sizing correctly. You cannot make Hail Mary passes at the market. You know, like I made this funny video on my YouTube channel where it's like a drill sergeant saying, "What is your major malfunction?" You have to keep really tight stops, and you got to scale in to your winning trades. There's no two ways about it. I mean, you know, you're leaving so much money on the table if you fail to do so. Okay. Here's another example of a cheap gap continuation, New York Times. What I like about this guy is a 2-point run, 15 to 17. We got a stick is street talk for a point. So we got two stick run, gap continuation, took out new highs. Another quick rider downer. I'm an expert at avoiding false breakouts. You need to always, 100% of the time, anticipate what I call a safety buffer or a false breakout region and not trade within it. Because how many times, show of hands, whenever I ask this at Money Show, I always get everybody's hands go up. How many of you have ever gotten into a trade that broke out and, hey, it finally broke resistance, I'm glad I got in. And then it comes down and goes against you and you get stopped out. And then to rub salt in the wound, it runs up without you. So directionally you were right, but you still screwed up and managed to lose money, much to your embarrassment. Well, I made that mistake quite a few hundred times in my early years, and what I learned was thou shalt not trade right above resistance. There's going to be a false breakout region. Now this chart's fine. This one didn't have a problem. But, you know, many other times you're going to see false breakouts. So as a trader, you got to figure out how to sidestep those. And the best way, you know, for example, here's one. This didn't pull back too hard, but it's still an example of the concept. Often things will break out above a previous high only to go down and you get worried and you say, oh crap, the trade didn't work out, I get stopped out. And then it runs 2 more points up or 3 points without you. You get really frustrated. And then I say on the count of 3, everybody pretend you're Homer Simpson and go, dope. So dope. I always have people say that at my public it's funny to hear a room of 300 guys and ladies say, dope. People stick their head in the room. What's going on in that room? I always say, show me the money. Anyway, the point is, always anticipate false breakouts and control for those by using a filter, 30 to 50 cents or so. There's no magic to it. I mean, it's not like a spreadsheet, but somewhere above minimum 30 cents or so. I usually use 50 cents above whole number highs to get in. So 33.50 would have been the trigger point on this guy, would have got a fill at 33.6. The point is, always anticipate a false breakout at new highs. Okay. One question one of my traders asked me was time stops. If something stops running for a continuous maybe 4 or 5 days in a row for a swing trade or for a day trade, if you got something it's in heat and it runs up and then it goes sideways for 5 or 8 minutes, I'll tighten up a trailing stop and let the market noise take me out of the trade. You can see a pennant pattern here, right? This is a bull flag. We got the flagpole ran up. This is what's called a mean reversion pattern, and you can see here, Harry mentioned head and shoulders. Here's an inverse head and shoulder that broke the neckline right there. So that was a buy signal here. I published an article internationally on mean reversion day trading and another article on swing trading, breakouts for technical analysis of stocks and commodities. In that article, I used Harley Davidson as an example. This is Take Two Interactive. This is the chart pattern, what I used to call colloquially a 1, 2, 3 pattern. It's basically where you got to move up, a pullback down to around 50%, and if you see a reversal pattern, maybe a hammer or bullish engulfing or an inverse head and shoulders like this one, then that indicates a new buying signal. Okay, so that's another way to trade these kind of charts, right? You've got a mean reversion. It gaps up, so that tells you buyers are in the house. Jump on board, and even if you miss the first big breakout and you miss shorting the drop, which is entirely possible, you got a inverse head and shoulders mean reversion pivot play right there. Now, I am a huge, epic, legendary fan of whole number support and resistance because it happens so often. I mean, just look at the answer key to these charts. 68 was resistance here. 67 is support. Open range breakout, 66. Kind of like when I used to travel the world as a quality management consultant for Fortune 500 companies. I used to be a top quality management guy. I was one of the youngest consultants in the industry, and I worked with executive steering committees around the world and had all kinds of fun Well, anyway, the thing is, you have to look for anyway. So when I traveled, I'd spend a lot of time going to the Hudson News shops at various airports and getting those word search puzzles. This is back in the old days before cell phones, before the internet was all hot and everything. Anyway, uh, this is kind of like the answer key to this chart. Look at the whole numbers. Aha, I didn't see that answer key, Ken. I'm glad you pointed that out. The mean reversion is good and important, but even more important is to look at whole number support and resistance. So I will buy, again, 50 cents above a whole number high for breakout, sell into a whole number. I mean, it takes them off the table once it gets to that point, close out the trade at any troublesome pullback off the major thing there. The whole number at 68. Stay out of the trade on the pullback, and then buy a pivot if it gets back over the whole number resistance at 67. I've done tens of thousands of trades, and that's one of the core patterns is look at whole numbers. Another key, I do not like trades, I do not like charts under $10 a share because they often are choppy and don't run much. I prefer charts in the maybe $30, $40 share range. That's kind of my wheelhouse. You know, charts like this one, or this one, or this one, or this one. You know, charts that have nice continuous trends make a lot of sense. Now let's take a quick look to wrap up today's festivities with our 90-day candlestick chart. This is really important. I teach this in my swingscans.com swing trading weekly webinars and alert service, but we look at both the 15-day, 15-minute chart. That's www.swingscans.com. And now back to our regularly scheduled program. Bada boom. Gotta have fun with this. Anyway, look at a 15-day, 15-minute candlestick chart to see the close-up for swing trader. This is a kind of close-up chart, but also look at your daily 90-day chart to see what the dominant trend is. And the main thing I look for is the high to the whole real body green candles to see if we have emerging strength, especially if volume is increasing, like we see here in Activision. We got increasing volume from today to yesterday, up gapping to new highs. That's on fire. Okay, now I still don't buy right there. I may give it a little room to run, but you know, another tip is look at these 90-day charts. I'll also use the 50, the 100, and 200 simple moving average. That's what my institutional guys use, and that's what I use. That's why I use it, because that's what their CMTs and their tech guys are using. So even though there's not a sign of a, you know, that's not a hammer, okay, there's no bullish engulfing, but we did see support at this 50 SMA. So again, I do not buy inside ranges. I always wait for buyers to come in. And for more on candles, learn from my colleague Steve Nissen. Speaking of which, name that candle. I make you guys think. I used to teach MBA courses for private universities, and I always like to kind of catch people by surprise and make them put their thinking caps on, because adults learn best by doing. Adult Learning Theory 101. That is a bearish engulfing, right? So after an uptrend, that tells you to sell under the low here, which would have activated there. Okay, and it found support. Now it finally started to break to new highs, and I like to buy strength up in this region, and it continues the madness on up to new highs. Activision, another good chart in progress. One thing I want you to pay attention to are these wide candles. One pattern that I've taught for years is tall green candles at the right side of cups or congestion zones. Other educators have since ripped off my pattern and gave it a fancy name, but I originated the concept, to the best of my knowledge, of this type of a pattern. Here's one, ILG. You see a large green candle at the right side of a bullish cup or a congestion box. Buying above the high of that candle usually works out. That's the voice of the breakout pattern. This is an ascending triangle. So we've got a bullish cup, an ascending triangle, large green signal candle at the right side of a congestion or pullback chop area. We've got some doji here. They don't know what the heck they want to do. Doji here, doji here. That's the name I give to our little Shih Tzu, doji, because she chases her tail, but she doesn't know what she means. My wife's from Japan. She tells me doji means, I think, clumsy or something, or uncertain, something like that in Japanese. Anyway, the point is, been married to the woman 20 years and still don't understand her. But hey, that's the key to great marriage. Marry somebody you don't understand. Then you don't have to talk as much. It's great. Epic win. Anyway, I digress. What a rock star chart, right? This guy ran from 19 to 26. He got a 7-point run in ILG. Look for, that's another rider downer, is a wide range green candle recently before you buy. Okay, if you got a lot of dojis like these, or you've got an uncertain chop area, stay clear of those. Instead, we like charts with continuous trends. You could have kind of thrown a dart at this, maybe would have taken one stop on a hit there, but the other 4 or 5 times you would have traded, it would have worked out just fine in JD. Here's KEM. Large green signal candle. Buyers in the house. Volumes buying up supply. And we've got a new breakout. Okay. Here's another one. Now this one I don't particularly like. This is kind of a 3-line break, almost not quite. It's not quite technically, so therefore it's not really a 3-line break. But for those of you familiar with candle patterns, if you have this stair-stepping pattern, and this technically needs to match up with that, so it's not really a 3-line break, but it's telling you similar weakness of buyers. You have the large buying candle here, then slowing down here, then slowing down there. That tells me, from a practical trading standpoint, that tells me, okay, there's some caution to be had in this trade. So with NYT, therefore, on this close-up chart, that tells me instead of buying, say, 1750, which I normally would, just 20, 30 cents above the high, I instead would be more likely to wait until, say, 1770, maybe 1780 to get in the trade. And the reason is because I did a good, quick, smart thumbnail multi-time frame analysis and saw that the buying pressure, this illustrated by this candles, is getting slower than this earlier big breakout. So don't get seduced by the dark side, Luke. The force is strong with this one. Score 1 for Hufflepuff. Yay, it's off. No, what I'm trying to say is don't get seduced by the huge, big, recent breakout, because that was then, this is now. The now story is the buyers are running out of steam. So I'd still buy a new high, is what I do. I'm a professional breakout trader, so I buy new highs. But I push up the trigger, number one, and I also use lighter share size on the initial trade if there's any sign for caution. I like the strength. I don't like the fact that the candles are getting narrower, and that's really important. These are good, quick. Took me, nearly 20 years to figure all this stuff out. So I used to be a corporate statistician for the Ford Motor Company and a nationally certified quality engineer. So I've got a quantitative background and then full-time trading since 1999. That'd be a good name for a song. Can't believe it's 1999. Anyway, good bullish breakout, congestion breakout from 61 to 69. A parting thought here before we wrap. Do not buy anything with a 9 in it, because that looks expensive. I've trained thousands of traders to sell 9s. Because anybody who's long from 61, or even if they got in early, 58, 59, whatever, by the way, validates the approach. Look at this. 9 ran into 3 months of hurt before it finally broke out. Nobody likes 9s. So don't buy anything with a 9 in it. It'll do what it did back here most likely, right? Which is not break the 60 for 3 freaking months. Okay, so don't buy. Perfect validation of my concept, right? It proves what I say is correct, at least on this chart. And I've tested it with thousands of charts. So I know it's right. I will not buy 69 to 70. I will instead wait till, say, 70 and a half before putting on a long in this guy, because I anticipate a reversal or a slowdown or a congestion, kind of like a couple that's arguing back and forth. Take out the trash. No, it's your turn to take out the trash. No, you did it last time. Blah, 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 blah. Just walk the freak away and disengage. Don't trade anything with a 9 in it, because it looks expensive to the crowd. Anybody who bought 61, I'm happy if I buy the 1s and I sell the 8s or the 9s, right? So that's a round trip for a swing trade in this region. So if you get close to a 9, good time to sell. Same exact thing is true on your intraday trades, right? If you get close to a 0.9 on a chart, or like this Cody one, it's fine to sell right under whole numbers, because that's usually going to be major resistance, and it doesn't do a whole heck of a lot after that. So it's fine if you get in during the breakout and sell at a 0.9. Same thing on your whole numbers for swing trades, is build the trade sensibly and look to exit the trade when there's a 9 in it. You can always rebuy a new high over the decade value, the 60, or in this case over the 70. There's another good one and another one. So another good large signal candle. So these are the kind of charts, at least, that I like to trade, and some of the insights that I've learned over many, many years, since dinosaurs walked the freaking earth, it seems. I like classic jazz. I like old school stuff, and I like charts that are authentic, that have integrity, that have authenticity, that tend to run, and it would have been really tough to lose money trading this guy anywhere. That's kind of the starting place. The punchline is you got to use tight stops with these charts no matter what you do, because when the end of you and I both know it's easier said than done, and one of the things that I think can really help you is figuring out how this works. So anyway, I am Ken Calhoun, president of Trade Mastery. You can get in on my free Saturday shindigs. We've got 4,366 registered as of February, currently up to over 4,400. So that's at trademastery.com/free. If you've liked this, don't spend any money on me for 6 months. Whoever says that, right? But I'm wealthy. I want your trust more than I want your money. If I can earn your trust with a lot of great free content, then I can earn your business. That's my strategy, and it's worked for me and thousands of traders for nearly 20 years. So that's at least how I roll. To use the kids' phrases, but that's how I like to run my business. I like to earn your trust the hard way by slowly, carefully doing stuff for free like this that makes sense. So what a cool top that is. Anyway, my web design guy got that up for me last week. Anyway, you can learn more. You can join me every single Saturday for free. I've been doing these for years. I did the first one back in the year 2001. So I've been doing Saturday webinars on and off for over 15 years. I originated that whole concept. Nowadays, it seems like everyone's doing Saturday webinars. Just like I started the first university concept, the Day Trading University and Swing Trading University.com sites, and other people copied my university idea. They also copied my Saturday. I'm the most widely ripped off guy in the trading industry. Well, boo-hoo, get over it. Okay, I did. But the point is, learn from me every Saturday for only 20 minutes. We go from 10 to 10:20. I usually show up early, so if there's questions, I answer those when we go over market forecasts. So that's a good way to learn from me. Another quick way to see if you like me, if you like my style, is take a look at my YouTube channel. My videos are really popular, which is cool. I've got me doing a drill sergeant bit here, but I got a lot of examples of entries and exits. Like when I just posted a few hours ago on that COTY winner from today, I like to shoot these videos. I got pretty women. The main thing is I got professional trading strategies and techniques that you can use. I used to do a series called the Ken Tank, which is kind of neat, kind of a takeoff on a popular TV show. But stop the madness. There's got to be a better way. A lot of free content there. Subscribe to my trading television channel at youtube.com/trading television, or that's the link to the videos, and I hope to see you guys there. So with that, I'm going to call it a day, and I wanted to thank you so much for being here with myself, Ken Calhoun, and my colleague Harry Boxer. We are the two best guys for breakouts that I know of in the industry, and Harry's been doing it longer than I have, so he's a great guy to learn great charts from, as am I. And if you like trading breakouts and good strong charts, we're the top two guys I know of in the industry for that. I have not seen anyone better than myself other than Harry Boxer for breakout charts. So he's a great guy. I highly recommend Harry. He's one of the good guys you can trust and work with. I've earned the trust of thousands since 1999 too. And here's Harry and I back in New York a couple of years ago at the Money Show. It's always fun to get out from behind the monitors and shake hands and see you folks. You guys have been amazing. So thanks so much for being here. I appreciate your enthusiastic words, and I hope that this starts giving you some food for thought between what Harry shared with you and what I share with you. Start making some resolutions to do things a little bit better, a little tighter, a little more differently than what you've been doing before, and hopefully start making a go of this as a trader. So you're welcome. Thanks so much. I appreciate that from all of you. Thanks to all of you for writing in. So take care, and I will get the video up to the YouTube channel soon, and I'll get you a link to that within 24 hours. So take care, and best wishes for success in your trades.